Options traders and Cobra trading students, this is Cobra 1 giving you guys a recap on December 3rd, 2019. I will try to make this brief for all of you. So the SPY closed down over 2.5 basis points, okay, exactly 0.85%, locking in another distribution day for today. That makes us 4 on the S&P 500 and 4 on the NASDAQ with distribution selling coming into play. All right, looking at the futures. The NASDAQ closed down 0.32%, gold down 3 basis points on today's open. Crude oil closed up 0.32%, and its futures are slightly elevated after today's hard sell-off. Okay, one thing to keep in mind is that ISM numbers and manufacturing were not great, and fear sentiment on China trade war is what's hitting us. One thing I did want to cover with you guys is the advancers and decliners. As of right now, when we look at the S&P 100 index watch and we put this out on a visual basis, we can see the advancers versus decliners. Put volume and put to call ratio is significantly rising. Decliners as of right now are 78 in the S&P 100 over 21 of the names within the S&P 100. We would likely need to see a correlation of 90 in the declining area of traded stocks and at least a 10 or lower in order to see some correlation or conviction into an actual market trend, which is changing into bearish territory. As of right now, do I think that this is significant sell side activity? I mean, it was pretty bad today. We actually did come down to our 1 standard deviation expected move for the week, tapping at the lows. We are getting into higher volatility. There was some heavy sell side volume that came in as well too. If we actually take a look at our monsters of tech and just review, what kind of occurred today in the market. Last week our monsters of tech actually closed below our expected move, which imply a 1 standard deviation within the options and what the market was pricing in, with the bearish candle. And we saw some significant sell side activity today following on the Monday. This was last week during the Thanksgiving holiday into the half Friday that was open for the half session, and the market absolutely did see some sell side activity today. Okay, so one thing to keep in mind is that we've been pretty much correlating within a standpoint and staying within a convicted range. If we look at this green line and red line, this is providing us an expected move of 1 standard deviation, and for the most part for the last 17 weeks, over a period of time, we've actually had nothing but a straight grind, a rise and grind, not just in the monsters of tech, but also the S&P 500. One thing to keep in mind as well too is that when drawing on a regression line from early October leading up to today, we can start to see that we are beginning to actually hit these low ranges of our regression line and falling outside. I mean, if we break below this 310 level, or for the most part, what we should be looking at is the SPX. Breaking below the 3104, 3103 level would imply further selling within the marketplace. Now, fear sentiment engage has changed and shifted gears just a little bit. Do I actually think that this can imply further selling? Yes, it can, but what we should really do is this allows you an opportunity to pre-position yourself for short opportunities. Are we there yet? Not quite. However, keeping in mind that our market is beginning to shift gears, you may want to seek out names within sectors that are favorable for short positions. And we'll cover some of those sectors in just a moment. And some of those sectors that are actually leading and where institutional money flow is actually rotating to can also provide you ideas. Now, based off of this contrarian scan right here, when we are reviewing what occurs in the actual market and what to look for, one thing to consider is when reviewing the market right now, we've actually breached outside our volatility bands. Volatility is contracting. Our RSI is coming back into ranges after being overbought for a period of time and beginning to weaken. Our momentum is now crossed. However, we have not yet crossed within our 80 range, or our 20 to 80 range to be exact. Teal blue box lines. Okay, we need to get back within this range to see further selling momentum to push us lower. And our money flow, institutional money flow, is actually decreasing right now. So institutional money flow is actually pulling out of a risky market. If you guys had watched my video of last week, I actually spoke about volatility and volatility futures. Now, a steady grind is when we see what's occurring in the actual market, and what we see over the last 3 weeks is a drop in price. Okay, so we see that the VIX, which moves inversely, or let's say, the market for this part moves inversely with the VIX. We can see that VIX continues to get sold off as our market continues to grind higher. Okay, for those who actually don't follow what I'm saying, it's if we actually compare this with our S&P 500. Okay, this is our market, this purple line. As our market continues to grind higher, our VIX continues to grind lower. Okay. So for those who didn't actually watch the video last week, what are firms doing, or what are major firms doing when they're not buying put options and our market is continuously grinding higher? Firms are selling volatility to retail investors, or just investors in general, that actually want to put on insurance for what's to come. When we're hitting all-time highs, fear sentiment then begins to kick in because people are expecting some sort of pullback, and that is what we saw today. Now, when firms continue to sell volatility, eventually these firms will have to cover the volatility, and they do so by hedging off or selling their sold volatility to a market maker who's willing to buy it, and then the market maker then buys ES or SPY futures in this case. So what we got today was, or what we've seen over the past week is firms selling volatility, and then what we've seen today was actually a hard blast and a move to the upside, based off this volatility. I mean, look at that bar right there. Okay, ISM numbers were not that great, but firms that did sell volatility eventually needed to cover, and we did see a little bit of that today. Okay, so this does point to a potential for further selling. However, expect actually a buy up on tomorrow's open market. Our S&P futures are up right now, usually after our hard sell-off for the day. We usually do catch some sort of rebound. Is there anything to be alerted as of now? I do not think so. I mean, as of right now, it is an indication for a little bit of weakening within the market. We are at 4 distribution days within the S&P 500 and the NASDAQ. However, in order for our market to actually pull, it would not be the tech sector that actually needs to pull alongside the market, or make the market sell off harder. It will be our XLF, our financial sector, which is holding up our market right now, which did show a little bit of sell side activity, closing down 0.63%, more than half a point. This is a good indication for those who actually have been getting into trades with me and have been holding short position on XLF with me. Congratulations, because this does look like it will begin to move. But in order to see our broad market continue to sell off, we would need our financial sector to be aligned, if not lead the way. It is not our tech sector that needs to sell off. It is our financials that is currently holding up our market right now. So if our financials continue to lead down the way, then we'll likely see a broad market sell off. Now, the one thing that is holding up our financials are our bonds. Okay. So bonds have been on a little bit slight of an uptick as of last week, and we came and we bounced off this regression line to a lower end. However, one thing to keep in mind is that if the market does continue to sell off, people are going to look for safe havens and places to go, and one of them being bonds. Okay, so if our bonds continue to tick up because of fear sentiment, our financial sector would then take a beating. Another thing to consider with our short position in XLF and also our bond market is our emerging markets. Okay, our emerging markets have taken a little bit of a some sell side activity, and our actual 5-day and our 20-day moving averages are beginning to cross over. However, they haven't gotten there yet. Now, if emerging markets, China being one of the heaviest weighters holding U.S. bond markets, and also Japan being one of the biggest weighters in holding U.S. debt, if we do begin to start seeing some sell side activity within their emerging markets, what's going to happen is that there will be fear sentiment that gets placed onto China, and China in turn is going to turn around and buy U.S. bonds. If U.S. bonds are bought, that's also going to take a hit on our financial sector, and with bonds moving up higher, our equity within the market will in turn also take a hit. So those are things to consider, is that Fear sentiment that sets in for the emerging markets will inflict more pain on our U.S. markets, which would be good for us or those who are actually looking to capitalize on our short position in the financial sector. Now, what do we see today? If we actually look at our overall sector tracker and see what sectors outperformed, the only sectors that did receive money flow were our consumer staples. Now, if we look at every single current sector right here, we can see that we've closed down or closed flat in some, but our only sector that did receive money rotation into it was our consumer staples, which leads us to believe that, also keep in mind that our 5-day exponential moving average is also crossing above our 20 on the daily. This makes for a good play into some of the names within the consumer staples. Now, what does this mean? I mean, does it imply further selling? It can be a start. However, we just don't know. I mean, if there's follow through to actually what's occurring, then yes, there will be more volatility that kicks in and more selling. But in order to see more selling, as I stated before, we would need financials to lead the way. However, we can look for the most bullish sectors and the most bullish industry groups that have, bullish trends and money flow persistency that is rotating into it, and select the top performers within the actual sector itself. So some names actually stick out to me are Procter & Gamble, okay, Walmart, and we can actually check out Altria Group. These were some of the ones that were favored upon. Kimberly-Clark, maybe we'll take a look at it. Personally, we want to see the weighters in the actual market, with Procter & Gamble holding a 16%. This will be first on my list to actually take a look at. Walmart holding a 9% play. We could actually see. Let's take a look. As of right now, we had a hard market sell-off in S&P. Okay, we came down to our expected move. All right, our weekly expected move, straight down to support. It's foreseeable that we could likely see a rebound back up to 312 or 314 on the open tomorrow, at least before catching some more downturn or a downdraft lower. So one thing that we do keep in mind is that, okay, if we are anticipating a bounce upward or a retest at least up to 312 or 314, our optionable markets expect to move for the week, of where the markets are actually pricing in where we can move to. We can see there's a median of 314. Now, if we do break below 3104 or 31, in this case, if we're looking at the SPY, we do break below this expected move of 310. We can absolutely, unequivocally see more heavy selling coming our way. Algos and computerized machines will be triggered to have a lot more orders to the sell side. But in this case, what we are looking for are bullish industry groups, bullish sectors, with the pop and a retest up in the SPY. So what we can see is that if we do get a retest to the SPY, with XLP being correlated with our S&P and also closing off of higher volume with a strong candlestick for the sector itself, we're going to take a look at Walmart. Walmart right now did close off on higher volume with, a hammer like the sector itself, and we do have an expected move up to 120. Okay, provided that our market does move up on heavier volume, okay, for a possible rebound after today's hard sell-off, we can likely catch a $1 move between now and Friday off of it, especially if money continues to rotate into our consumer staples. Now, people are looking at consumer discretionaries and consumer staples, and what does this mean when you're looking at consumer discretionaries and consumer staples? Is that, hey, consumer spending is cut back. Maybe you can't afford the TV this Black Friday, but you definitely need the toothpaste to brush your teeth, right? So you definitely need the body lotion and the soap to wash your body when you're in the shower, at least for those that do use soap. So consumer staples are moving higher as the rest of the market continues to move lower or remain flat. Okay, another sector to keep an eye on is our energy sector. We have, the 5 crossing over to 20 with a bearish candlestick off of higher volume. Look to get short in the XLE or names within the XLE for short side positioning. XLU does move alongside with our bond market. Now, the difference between XLU and the bond market itself is that sometimes when investors are actually looking to rotate their money into XLU or the bond market, some of them will preferably like to select the XLU simply because of the dividends, the $3 dividends that you receive every quarter. And just like the bond market, or XLU will move somewhat correlated to how the bond market moves. Let's see. I see some weakening in our home builders and also our industrial stocks. However, we're not there yet. We did see a lot of sell side activity in our industrial stocks. Caterpillar itself did catch a bid to the sell side for today. Okay, down 1.77 basis points. Boeing also did catch, some sell side activity in the Dow, down 10 points, 10 basis points on the open market today. XLB, or home builders, is actually beginning to revert and cross over 5 and 20 exponential moving averages. However, we are not there yet, although we did see some follow through from the past 2 days with some sell side activity with higher volume today. So this is something that we can also add onto our watch list. But for the most part, what I will be looking for is a possible rebound in our XLP consumer staples for tomorrow. Walmart being one of them, which we just covered. Another one that we could take a look at is Altria Group. Okay, we are actually on a steady grind, hitting our expected move, and today is only Monday. We've already tapped our expected move for this week. We are on higher volume right here, so we can possibly expect this stock to move higher if it gets rejected off of this. If it doesn't get rejected off of this 50-80 level, this 51 level right here, did make a 1.81% move, or almost a dollar move on the open market today, and we actually are coming up, tapping into resistance at this 51, possibly 52 mark right here. Okay, so it is something to consider. I would not recommend shorting. Some people would like to short probably at this high level right here, based off of this volume and the actual sector itself moving upward alongside with a possible rebound. And also SPY futures as of right now ticking up higher. I mean, of course, anything can change overnight. I probably wouldn't recommend shorting against the actual trend. Sail your boat in the path of least resistance. Go with the current, not against it. Okay? But yeah, if you are a momentum trader and you do want to actually take this trade, a vertical or back spread ratio possibly up to the 51, 52 level will be ideal to actually get long into if you are a long bias trader. However, Walmart does look better to me. Lastly, the one thing I did want to cover and take a look at is possibly Procter & Gamble. We could take a look at it as well too. Procter & Gamble also closing off. This probably looks like the best setup that we possibly have, with an expected move placed in for about 123, 124 for this week, with a strong candle off of higher volume. Now this and Walmart look pretty good to me. Consumer staples, if we continue to rally and see market rotation and money flow move into it, will be absolutely one of those sectors that I have an eye for this week. Simply to day trade. However, there could be potential upside if our market continues to broaden and sell off. Now, one stock that I did take profit on today was Roku. We did take and capitalize on this trade. We opened it last week at 162. It dropped down to 132 on the open market today off of higher volume, and people who actually took this with me, took up to 70% return on investment profit, and that was absolutely a good trade. A stock in a trade, or a trade that was opened up today, was TLT to the long side. Now the reason why this was opened up is because, well, based off of ISM numbers, and bonds continuously wanting to tick up higher, being at support right now, and our broad market being at resistance, we can see that if bonds continue to tick up, we will actually see an increase in TLT. So a vertical call was opened up at the 136, 138.50 strike, 136.50 to 138.50 strikes, buying the 136.50, selling the 138s. Okay, a vertical call was opened up on this right here, and we're seeking a 55 to 65% return. This position is in profit right now after that ISM report came out. That is one of the plays that we are looking at. And for the most part, guys, that's all I got for you. So I'll see you guys tomorrow in the trading room.